Hello, welcome. Thanks everyone for joining today. We're gonna wait for some more people to get in here, but in the meantime, feel free to drop a message in the chat. Let us know where you guys are located. I'll put a message in there now so you can kind of see where that is. And then if any questions pop up throughout, feel free to just put those in the chat as well, or we'll also save some time for the end. Great. Thanks. I think we're ready to get started. My name is Jack Quinlivan. I'm a team lead and senior consultant here at Leyton. I'm at our U.S. headquarters over in Boston. I think, kind of a little bit of background on today. We'll kind of just give you a rough agenda. We want to go on to the next slide. So a little bit of background on Leyton as a firm. Leyton's been around since 1997. Originally a French company, so started up in France, now have 50 offices in 17 different countries around the globe. And we exist as a specialist financial consulting firm that works on various specialized federal and state tax credits and incentives, some of those being in the commercial real estate space, which is really going to be our primary focus today. We've really tried to penetrate the market over the last couple of years, hired a lot of smart individuals such as Sean and Cedric to help kind of lead our team. And with some of the changes in the tax code through OBBB last July, just kind of want to talk through what those changes are and how that kind of impacts the 45L credit, along with some other programs moving forward. As I mentioned, my name is Jack Quinlivan. I'm in our Boston office, been at Leyton for almost 6 years now. And I'll kind of kick it over to Sean and Cedric to introduce themselves.
Yeah. Hi, everybody, and thanks for showing up. We hope that we're able to provide you with useful information that you can take in action. But my name is Cedric James. I am the Director of Commercial Real Estate here at Leyton. I've been in this space for about 10 years. Big fan of commercial real estate and residential real estate. I do own a few properties, and I'm always looking for more. So if anybody has any good leads, send them my way. But very happy to be sharing this information about 45L. So I feel like it's a very underutilized incentive. So we look forward to sharing this information with you.
Yeah, my name's Sean Reville. My background actually has been as a HERS rater, Energy Star certifier, Zero Energy Ready Home certifier. I worked in one of the first ever counties to adopt Zero Energy Ready Homes as their building code. And for the last 3 years, I've been here at Leyton helping with the 45L tax credit, which you'll start to see why my background is relevant to the 45L tax credit by the end of this presentation.
So a little bit of the agenda. We're going to go over 45L, bird's eye view, and then we'll start to drill down, talk specifically about Energy Star ZER, or Zero Energy Ready Homes, and the sunsetting considerations that we need to take as building owners. Then we'll talk about a few other incentives that are relevant to folks that can claim 45L, and then we'll end with a Q&A. As Jack said, feel free to ask any questions as they come up. We'll try to answer them as we go along. But if we miss any, then we'll make sure to save some space for the end to make sure we answer those. All right, so we're moving along here. Sean, you want to take it away?
Yep, sorry. So 45L is the energy efficient new home tax. The tax credit goes to the eligible contractor of new residential homes that meet certain energy efficiency requirements. So the tax credit does apply to both single family and multifamily homes. And the Eligible contractor is whoever holds equity in the building during the construction phase. So it's not the person that's specifically necessarily down there on site building the building. It's who owns equity in the project while it's being built. The 45L tax credit is a general business tax credit. It's claimed on Form 8908 on the year that the building, on the tax year that the building is completed and occupied, which is a key distinction there. It's a dollar for dollar tax credit to offset tax liability. And if there is multiple owners of a project during the construction phase, it flows to individuals on their K1s based on their equity in the projects. It is available to claim through an open tax year. So that means you have basically 3 years from when the building is completed up to 3 years after that to claim the tax credit. So we'll dig into the energy efficiency requirements exactly, because they change the requirements over time. Usually it does require energy modeling, and there's always a requirement that there's site inspections by credentialed individuals.
And Sean, one thing I think you might have touched on it there, but can you just kind of clarify whether or not it matters that the eligible contractor who had equity in the building during the construction phase, does it matter whether they still own the building or buildings?
No, so theoretically they don't. As long as the building is completed and occupied in that tax year and they had equity in the project during the construction phase, they can still claim the 45L tax credit.
Nice. So next, we just want to talk again. We're still at the high level here, 45L. So we want to understand, when did this incentive take place and what was the timeline for it? So this was originally part of the Energy Policy Act of 2005. So it's been around for a long time. And in 2023, the Inflation Reduction Act changed the behavior in multiple ways, really, but two main ways. One is the energy efficiency piece changed, so it increased. Two, the amount that the eligible taxpayer is able to claim also increased, but in order to receive that increased credit amount, there are a few hoops or criteria that must be satisfied. And we have a slide for that here in a little while. And then lastly, with the big, beautiful bill that happened in 2025, this accelerated the timeline for when this incentive sunsets. Originally, it was set to sunset in 2032, so there's plenty of runway. However, it is now set to sunset June 30th, 2026. So it definitely sped it up a little bit. And all units, in order to be eligible, all units must be sold or leased before June 30th, 2026 in order to be eligible. Okay. So this next slide, we're going to get into a little bit of the differences between the energy efficiency that I started speaking to. So there's the legacy 45L, that's the pre-Inflation Reduction Act. And then there's the Energy Star and ZER. So these next few slides are going to dive a little deeper into that energy efficiency piece. Sean?
Yeah, so legacy 45L, which is the term we use, but it's really 45L before the Inflation Reduction Act, is been around, as Cedric mentioned, since 2005. It started being implemented in 2006. It is a $2,000 tax credit per dwelling unit. As I mentioned before, it is accessible through an open tax year. So theoretically, if you have not yet filed your 2025 taxes yet, you can still go back and claim for buildings built in 2022 through an open tax year amendment. And the energy efficiency requirements actually changed a couple of times, but for the majority of the time, it was you need to show that the building or the dwelling unit had a 50% reduction in heating and cooling loads compared to 2006 International Energy Conservation Codes. So with that, you needed to show that through energy modeling on a DOE-approved software. And there needed to be a third-party analysis with a site inspection for certification to ensure compliance with the energy efficiency requirements. And it applied to single family homes and apartment buildings up to 3 stories.
And Sean, I have two questions on this slide. So with the legacy version of the 45L credit, IECC 2006 seems like a fairly low bar to be compared to. Can you expand on maybe the things we would see from a 2022 build, which tends to kill the model and maybe doesn't perform as well in our energy model up against that 2006 standard?
Yeah, so So if you're not familiar with the International Energy Conservation Code, updates itself every 3 years with a goal of being 10% more efficient than last one. So most buildings are on a 2018, or sorry, I should say most municipalities are on a 2018 IECC code compliance. And with that, most buildings were qualifying, which is probably one of the reasons why they changed the energy efficiency requirements with the Inflation Reduction Act. So that being said, buildings still don't qualify, even if they were built recently, even if they were sometimes in 2018 code cycles. One of the biggest things that we've seen that pretty much makes sure a building will not qualify is the use of packaged terminal air conditioners as the primary heating and cooling system for a dwelling unit. So those PTACs tend to be really leaky. They tend to be really inefficient and generally cannot pass the energy modeling requirements. Similarly, we found that a lot of CMU, concrete masonry unit construction, really struggles to pass the energy modeling. So those tend to be the two big ones that if we see that, our alarms are raised that it's probably not going to be qualified.
Okay, cool. Yeah, and then I think my other question just is as far as the 3-year statute of limitations. So say I filed my 2022 taxes on extension, ultimately filed those on July 1st of 2023. Does that then give me until July 1st of 2026 to claim the legacy version of the 45L credit on my 2022 build?
Exactly, yeah. So it's based on the filing date of your 2022 taxes when you're looking to amend through an open year. And that applies to any amendment year.
Great, thanks.
Great, Sean. I think Gary had a question. Can everybody hear Sean okay? It looks like Omar might have a few issues, but it sounds like everybody else is. And Sean, I just wanted to get to Gary's question. He says he's a new building owner, or he has a new home or a new building, and I'm not sure if he was the equity partner or the GC, but it completed in December of 25. Is it possible for Gary to still claim the credit?
Yeah. So with the open tax year, you could claim it on your 2025 taxes. You theoretically have up to 2028 to claim it still. That being said, we're going to dig into some of the energy efficiency requirements that the Inflation Reduction Act introduced. So assuming that the building meets those energy efficiency requirements, then yes, you can claim it.
All right. So next up, guys, I just want to walk everybody through what the value is and kind of use this table to illustrate the difference between legacy 45L, which is that column that's tax year before 2023, and the newer version, the Energy Star version, which is the last column on the right. So you can see for multifamily, we'll start there. The IECC code, as long as it's more than 50% savings, then that person or that taxpayer is eligible for $2,000 per unit. Okay, they don't have to have any additional requirements. They just have to be able to pass IECC 2006, and they have to make sure that they have equity in the building. And moving forward or moving down that, you'll see Energy Star and ZER. We're still in the multifamily section. And what you'll find is after 2023, the IECC code is no longer relevant. It moved to Energy Star as the standard. And if you are a multifamily developer and you are and you got your Energy Star certification, each dwelling unit is eligible for $500 per unit. If it was Energy Star and prevailing wage was paid, it is eligible for $2,500 per unit. Okay, same concept with ZER, right? If you're a multifamily builder and this is after 2023 and you completed Zero Energy Ready Home certification, each unit is eligible for $1,000 per unit or $5,000 per unit if prevailing wage requirements were met. So the key takeaway here is prevailing wage is a 5 times multiplier. Moving down to single family homes, this is interesting to note, right? Because you can see in the legacy version that it was up to $2,000 per dwelling unit. So any units that were placed in the service before 2023 can get up to $2,000 per dwelling unit. Now, after 2023, if it is Energy Star certified, you can get $2,500 per dwelling unit with or without prevailing wage. Okay. And same thing with ZER. You can get up to $5,000 per dwelling unit with or without prevailing wage being met. So the prevailing wage criteria is only really matters for the multifamily builders. Okay. We're going to move on to the next section here where we're going to start talking about Energy Star and ZER. Sean, you want to just kind of start to break down Energy Star?
Yeah. So Energy Star Homes was established in 1995, a couple of years after they created the efficiency standards for electronics and appliances. So if you're probably familiar seeing the blue Energy Star label on your microwave or your laptop, and basically this concept is the same thing, but for your house. Since 1995, it's gone through 3 major version changes. So they've been updating it to keep up with the latest trends in energy efficiency with new technology and better science. And each version has numerous revisions. So they're constantly working on it and updating it. For buildings built and occupied between January 1st, 2023 and June 30th, 2026, it is required that you get Energy Star certified to claim 45L. For single family homes, it always involves energy modeling. It's a little different for multifamily. They have different pathways options for multifamily, which we'll dig into a little bit later. But single family always involves energy modeling, and there is always on-site verification by a credentialed HERS rater who has also been passed certain exams to be Energy Star certifier. So there's actually, I should specify, there are other options now besides HERS. There's the Building Science Institute. They are qualified as well. So I don't want to exclude them, but HERS has been around longer. So that is the main one when it comes to mind for me. So on-site verification. There's always going to be pre-drywall inspections. That is something that's required by the program, and that's to look at insulation, make sure it's installed correctly, and at the amounts that contractor says it is. It's also to look at air sealing details, duct work, and just kind of generally and framing techniques used on the building, because all of those have big impacts on the overall energy efficiency of a building. Then we do what we call a final test out, which involves blower door testing, which is pressurizing a building and seeing where it leaks. Heat and cold travels through air much quicker than it moves through solids. So even if you had the most insulated building in the world, if it's leaky, it's not going to be energy efficient. Similarly, we do duct leakage testing. Let's make sure that the air running through ducts gets where it's supposed to go. Heating systems can't run efficiently if the ducts are really leaky and can also cause lots of other issues. So that's pretty important. Once, assuming that the building meets all of the requirements to be considered Energy Star, it's registered with the EPA upon completion, and so the building will be listed as an Energy Star home for as long as the building exists.
And Sean, just on as far as Energy Star goes, I know we've had a couple of developers ask about the drywall inspections. So just to be clear, right? If drywall is up, is it too late to then receive an Energy Star certification?
So they did make some exceptions for that on-site inspection for pre-drywall during COVID, but they got rid of those pretty shortly afterwards. So it is required that the HERS or this Energy Star certifier is on site and visually inspecting all the insulation and everything that we kind of talked about. So once drywall's up, the only way to still get Energy Star certified is if you were to tear that drywall down, and that's pretty much cost prohibitive.
Yeah, no, that makes sense. And I guess, are there specific states, if if you're building to code, a developer might already be closer to achieving those Energy Star standards in comparison to maybe some other states where the building code isn't as high?
Yeah, so it depends on which version of Energy Star. We'll dig into that a little bit more, but it depends on which version of Energy Star that you're going for. That being said, some states, for example, like Massachusetts, their state level requirements tend to be actually more efficient than what's required for Energy Star, at least from an energy modeling standpoint. So that being said, it also can be very dependent on down to the individual municipality. So, some people might be like, oh, Texas is a pretty red state, they're not going to be energy efficient, but a lot of the cities in Texas have their own requirements that are really energy efficient and already close to meeting those Energy Star requirements.
Okay, cool. And then I know it can vary pretty significantly based off of building size or how many homes there are, the number of units. But just generally speaking, can you kind of give us just a run through as how long that on-site verification could take?
Yeah. So it all depends too on when you're doing the inspection, like what tests you want to do when. So for example, like the duct leakage testing, you could technically do during pre-drywall. It's actually preferable because that way you can, if there are any issues with the ducts being too leaky, you can identify it and seal it up then. That being said, pre-drywall inspections usually tend to run from 1 to 2 hours. Once again, as you said, Jack, it really does depend on the size of the home or unit size in general. Whereas a final test out is going to be closer to 2 to 4 hours.
All right, great. Thanks.
All right. So we're still talking about Energy Star, Sean. So I'll let you continue your masterpiece here.
Yeah. So we're going to kind of dig into some more of the specifics here. So per the Inflation Reduction Act, buildings need to be Energy Star for single-family homes. They needed to be Energy Star single-family homes version 3.1, or if it's built in 2025, it needs to meet version 3.2. Besides some revision changes, the big difference between 3.1 and 3.2 is the energy modeling requirements for 3.1 are based on 2018 IECC, where 3.2 is based on 2021 IECC. So when you're asking, Jack, like, what are there any areas in the country that are better or closer to Energy Star? It's looking at those code requirements, which version of IECC that they're pursuing or that the state has mandated, that makes it easier to determine if it's worth pursuing Energy Star and which version in that state. So that's to claim the $2,500 for the tax credit, regardless of prevailing wage. And then Energy Star Multifamily 1.1 is required for all multifamily buildings. There was a plan to switch that to 1.2, but because of the OBB, that transition is never going to happen. So It's $500 per unit without prevailing wage, $2,500 per unit with prevailing age. One of the nice things that the Inflation Reduction Act did was claiming the 45L tax credit does affect the overall basis of a building, but specifically for LIHTC, they made sure that 45L no longer affects the qualified basis. So that means you can still claim the full LIHTC tax credit and 45L at the same time. It just makes them more complementary for one another. As I did mention, there's multiple compliance pathways. So for single-family homes, it's always using energy modeling rating system. So it always has to be energy modeled and then on-site inspections. For multifamily, you can do energy modeling of the individual units and then meet prescriptive requirements for the common spaces. You can do a whole building ASHRAE energy modeling, which includes common spaces as well as the individual units, or there's a prescriptive program. So no matter which pathway, it'll always require those pre-drywall site inspections and the final test outs. And there are multiple prescriptive checklist requirements that need to be met at both stages. Cedric, do you think this might be a good time to kind of, if you don't mind, go and do a little overview of what prevailing wage is in case anybody's not familiar with it?
Yeah, for sure. So the easiest way to think about prevailing wage is union labor, or it's more commonly referred to as Davis-Bacon wages. Now, there are some differences between prevailing wage and Davis-Bacon, but if you're doing Davis-Bacon, generally you're on the right path. You're pretty much there. And the key to this whole prevailing wage incentive is documentation, right? So if you are paying your contractors a prevailing wage, you want to make sure that you're documenting that, right? So if you're a developer, you want to make sure that your construction manager or GC is paying the subcontractors a prevailing wage. You can build that into your contract. In some states or some counties, the market rate is actually higher than the prevailing wage rate. So there are some websites you can go to check what the prevailing wage is. You may already be above that. It does definitely happen, but you just want to make sure that you're documenting it. So it doesn't always have to be a decision that happens as you're kind of penciling out the deal. Usually it does, though. So you will want to make sure that you consider this because 9 times out of 10, you didn't do it by accident. All right. So we talked about Energy Star, and now I like this graph because it kind of shows this graph here on the right. Sean, I'll let you take it away, but I just wanted to pull everybody's eyes over to the right. You see IECC is kind of the foundation, and then Energy Star, and then Zero Energy Ready Home. So it's kind of like a ladder approach or a stair-stepping approach to energy efficiency. So, but Sean, if you want to give a little bit more detail, I'll let you do your magic.
No, that was great, Cedric. I mean, you pretty much summed it up.
You're out there.
So yeah, Zero Energy Ready Homes, ZER is what we call it. Actually, the DOE recently changed it from Zero Energy Ready to DOE Energy Efficient Homes. But for our most intents and purposes, we're just going to call it ZER for now. It's the same program, just slightly different name. It's a green building certification. It's for high performance residential new construction, and it's really focused on energy efficiency, renewable energy, water efficiency, and indoor air quality. So while Energy Star is really mostly focused on energy efficiency, Zero Energy Ready Homes takes into account everything. So the idea is that a Zero Energy Ready Home is going to basically be in a state where it's energy efficiency enough that it's not net zero, but if you were to put solar panels on it, it would become net zero. And the way they do that is, as Cedric mentioned, is kind of this stair stepping. So part of the process of getting Energy Star certified, Zero Energy Ready Home certified, is to be Energy Star certified. In addition to that, you have to be EPA Indoor Air Plus certified. So that's another EPA program that you're getting. certified in as you're getting Energy Star or Zero Energy Ready Home certified. And then there's also several program specific requirements that we'll kind of touch on a little bit later.
Yeah,
I think
on Zur,
go ahead.
Sean, I'm curious, like how can you kind of explain how Energy Star and or Zur compare to some other different kind of building standards, whether it's passive house or NGBS or leads?
Yeah. So specifically with passive house, it is integrated into Energy Star and Zero Energy Ready Homes program in this exact stair-stepping kind of model over here on the right. So then if you wanted to get passive house certified, your building would also need to be Energy Star certified, Indoor Air Plus certified, and Zero Energy Ready certified. It's just going that next, passive house is going that next step. Whereas Zero Energy Ready, for example, you don't need to have renewable energy on the building. You just need to have the wiring ready to put it on there. So the building isn't necessarily net zero, where passive house is showing that the building is functionally net zero. So it's incorporates Zero Energy Ready Homes. It's just that next step. Where LEED and NGBS are different is their programs are based on kind of a point system. So you have different options and different criteria that you can use to get to a certain point system, which gives you, platinum, LEED, LEED, platinum, gold, or whatever, or NGBS, diamond. Energy Star, Zero Energy Ready Homes, Passive House, they all have like dead set prescriptive requirements that you have to hit no matter what. It doesn't allow trade-offs in the same way that NGBS or LEED does.
Okay, great. Yeah, that makes a lot of sense. Thanks.
Yeah, perfect. So we can move along here and just kind of talk through the considerations for Zero Energy Ready Home. Basically, it is the same as Energy Star, but there's some additional considerations as Sean was mentioning. And so you'll want to make sure that you think through these in each stage of the cycle, mainly in the design phase. Zur isn't something that you do by accident, and rarely is Energy Star, because you need those two pre and post pre-drywall inspections and post-drywall inspections. It's pretty challenging to accidentally stumble your way into an Energy Star certification. I think we've kind of gone over a lot of these checklists. Is there anything from this side that you want to make sure the audience knows, Sean?
Yeah, so I guess the big, as you mentioned, you don't stumble into it. Like as a builder, you have to register with the DOE as a Zero Energy Ready Home partner. So that's a key component. As I mentioned, these are some of the prescriptive checklists. So there's the Energy Star Radar Field checklist. There's another prescriptive checklist for the mechanical contractor. And Zero Energy Ready Home specifically has ones to make sure the building is what they consider photovoltaic ready. So as I said, you don't need to install solar, but you need to have it ready to install solar. Similarly, you don't need to have an electric vehicle charger on it, but you have to have it ready and set up to be an electric vehicle. And then what's important with Energy Star and Zero Energy Ready Homes is, as I mentioned, they get registered with the EPA and the DOE forever. The buildings get listed as these certifications on the MLS servers. With all of that, there are people who check the raters and certifiers like myself that do quality assurance before that final registration happens to make sure the buildings are meeting all that requirements. So that's always going to be your multifamily review organization or home certification organizations. They're the governing bodies that make sure that there are no bad actors, that the raters and certifiers are doing what they're supposed to do.
All right. So if you guys have any other questions, let us know in the chat. Otherwise, let's move on and discuss, the sunsetting of 45L. As I mentioned, listen, this incentive as it currently stands is going away, meaning all units, if we want them to be eligible to claim this incentive, have to be placed into service, meaning sold or leased. So it could be a condo or an apartment complex. It could be a single family home that you're renting or a single family home that you sold, but they have to be sold or leased before June 30th, 2026. What that means is, for example, let's say that you had a 100-unit apartment complex or even a 100-unit single family home community. All units were placed into service before June 30th, 2026. Okay. It doesn't mean that you have to claim them right away. You could potentially wait until 2027 or 2028. You still have the 3-year look back. However, it would go on your 26 returns. But the most important thing is that you understand the units have to be sold or leased before June 30th, 2026. Now, this is why we are hyper-focused on addressing all legacy opportunities. Any taxpayer that sold or leased units in 2022, we have until the date they filed to retroactively go back and amend those returns to claim the legacy 45L. So if you filed your 2022 returns in July of 2023, you have until July of 2026 to take advantage of legacy 45L. So it's important that you talk to somebody like us if you are interested at all in understanding if you have previous projects that completed in 2022. If this incentive makes sense, we can walk you through the tax implications. We can walk you through the technical qualification implications. But if you had any units or know anybody that had units sold or leased in 2022, it is a use it or lose it year as the statute of limitations is approaching based on when you filed. All right.
Cedric, I just had a quick question on the legacy version of the 45L credit there. So as we're kind of, looking back into that year, can you kind of just expand on how you go back 1 year and it can carry forward for 20 and, how the credit could actually also be received in the form of a cash refund depending on an individual's tax situation?
For sure. So those are two important factors in why kind of tax planning, you want to do these things with not only a technical expert, but somebody who can understand taxes. Because to your first point, you do have to go back. If you don't have enough taxable income or tax liability in the year that the buildings were placed into service, you have to go back 1 year to see if there's any tax liability in the prior year before you carry it forward 20 years. Now, in most cases, these are new entities. So going back 1 year, there's nothing to go back to. So in all intents and purposes, it is just a carry forward for 20 years most of the time. But every now and again, we have seen maybe some units were 2022, other units were 2023. Those types of considerations do come up. So, and then your other question, Jack, what was it about again? I'm sorry.
Yeah, just in terms of how the credit can actually be received in the form of a cash refund.
Yes. So if you overpaid your taxes and the 45L, and then you claim 45L caused you to overpay your taxes in previous years, you would amend the returns and receive a cash refund or a refund for the amount that you overpaid. If there's any remaining amount, then you carry that remaining amount forward to the next available tax year with tax liability to offset.
Wonderful. Thanks.
Yeah, absolutely. Sergio, I'll get to your question in just a minute here. Let me move on. I just want to talk about some other incentives. We're almost at the end, Sergio, so hold on for a few more minutes. There are a few other incentives that building owners take advantage of quite often, especially in the multifamily space. So that's the 179D tax deduction. Now, the big thing I want to point out here is the amount eligible in 179D is anywhere from $0 if it's not energy efficient, enough to claim, all the way up to over $5 per square foot. But this incentive is a tax deduction, and it's not available for single family homes. Right? It does need to be multifamily homes, 4 stories and up. So if you have a multifamily home, 4 stories and up that completed post 2023, it is possible to double dip and to take the 45L tax credit along with the 179D tax deduction. They are rare cases, but stranger things have happened for sure. So these are mostly for commercial buildings, but again, any residential unit 4 stories and up any residential building 4 stories and up, is considered a commercial building. So that's one additional incentive that you guys should be aware of as building owners. The second one is kind of ubiquitous in the industry, right? Cost segregation. You should absolutely be taking a look at cost segregation for all of your properties to determine if it makes sense or not. Cost segregation, if you don't know what it is, brief overview, it's a way to reclassify assets within a building to shorter tax lives. So you're basically accelerating the depreciation for those assets, pulling the depreciation forward, and ideally using it to go buy more buildings, right? And get a return on your investment right away instead of waiting for the life of the building. Some considerations here: you want to make sure that you hold the asset 3 to 5 years. You don't have to, but in general, that is it makes the most sense because of a concept called depreciation recapture. We won't get into that here, but I did want to highlight those two. I don't want to spend a ton of time on them, but I did want to highlight those two as well as a few others. And Sean, I'll let you talk through green financing.
Yeah, so green financing basically are, we are running out of time and there are some questions we want to get to. So we'll kind of briefly go over this, but basically these are all programs that if you get a green certification, such as Energy Star, Zero Energy Ready Homes, you basically get either a reduction in your mortgage rate or access to lower interest financing options, or in the case of energy efficient mortgages specifically, home buyers get up to a 97% LTV with that. So basically, depending on what certifications you get, lower interest rate mortgages, higher LTVs is kind of the way to sum this all up.
And with green financing, can you just touch on like how we can assist in some of those areas with some of our partners?
Sure. Yeah, so we're partners with people who administer all of those programs. So we can A, get you a good reference to them, and B, help you claim those certifications, because we do have people on staff who are certified not just in Energy Star and Zero Energy Ready Homes, but things like Passive House, and can help you get the most out of that. So those programs are still existing. They're not going away because of the One Big Beautiful Bill. Similarly, these are rebates. They're all at the state or municipality level. They're pretty much all administered by the utilities in the state or municipality. So they're not necessarily, the money is not necessarily coming directly from the state. So as I mentioned, or I guess I haven't mentioned, the place that I worked that had adopted Zero Energy Ready Homes as their building code was in Colorado. There are 3 municipalities that have those requirements. Some offer also HERS alternatives to the regular building code. That's a big thing in Texas as well. And out here, the state utility, one of the bigger state utilities, Xcel Energy, is offering up to $25,000 for new homes that get these green certifications. Massachusetts, always ranked #1 in energy efficiency in the country for a reason. Their state stretch goals actually includes getting Passive House certified for certain multifamily buildings in certain municipalities. And to help people get there, they offer up to $30,000 incentives, even more, honestly, depending on which, certain material choices and things like that. But they also have smaller incentives for Zero Energy Ready Homes and Energy Star. I already mentioned Texas. In addition to like HERS as an alternative to energy code compliance, some of the local municipalities at the town and city level will give you cash back rebates for meeting Energy Star. And New Jersey just recently put into effect this dollar per square foot, $1 to $2.50 square foot for getting these certifications, plus bonuses for certain materials. So that's been a big new one.
Okay, so I know we're tax consultants, but these rebates, these are not after the project is done, right? These are rebates that can be basically baked into the penciling out of the deal. into the capital stack, right? You should be considering these and confirming if your state or county has anything that you can stack onto to help your financing, to help you get these green certifications. And then lastly, you also could receive the 45L tax credit. You should do cost segregation as well if you plan to hold it. And then take a look at 179D. But I really, really like some of the questions that we have. Tom and Sergio asked great questions. I know Sergio was first. So Sean, if you wouldn't mind, can you read his, or do you notice to read it?
No, I can read it. So it's Sergio asked if you have in a 100-unit apartment complex, do all the units need to be leased, or can we claim on a portion? And the answer is that the credit is on a unit by unit basis. So if you had, so let's say 70 units fall within the relevant tax year and 30 fall outside of it, you can claim on the 70 that fall into the relevant tax year and exclude the other 30 from that tax return. So that's pretty straightforward. And Tom asked if for Energy Star manufactured homes, if we sell to a realtor before July 1st, 2026, but the realtor does not sell to the end consumer until after July 1st, 2026, then the home does not qualify for the credit. And you're correct in that analysis, Tom. They very much specify in the actual 45L tax code that part of what you need to have on file to share, have to have on file in case of an audit, is the actual customer receipt that they bought the manufactured home. So you don't actually need to submit that when you're claiming the credit. You just got to fill out the 8908. But if you ever were to audit, you'd need that on file to show proof that the building was bought by an individual. And Sergio. So it does not technically need to be occupied. The language they use is specifically purchased, and they said purchased can include leased. So that can be, so it can either be bought or leased, and that's the date you can go off of for claiming the tax credit, not when they actually move.
Yeah, we oftentimes use the rent rolls for that, Sergio, because they'll show when the lease was actually signed. There are some, this might be gray area, Sean, but might get to his point. You could lease up before the building's technically completed, right? It would need to be completed and sold or leased, right?
Yeah, so yes, it would be the tax year it's completed and sold or leased. So I have seen them claim that before based on the tax. People claim it where on the date that they leased it, even though that was about a month or two prior before the building was actually fully complete. So, there's no, for example, like TCO, if you have TCO and you can start leasing the units, then that's fine. It does not necessarily need to be CO dates.
Perfect. Well, hopefully that answered you guys' questions. If not, feel free to reach out to us. There's a ton of nuances with how it applies to the tax return. So, probably don't want to get into that on a live audience, but feel free to reach out to us and we can kind of review your tax returns, or we can go over those conversations with the tax expert and see if it makes sense to move forward. All right. But guys, thank you for your time. I know some of the stuff is a little heavy, but it's a very powerful incentive, and we strongly believe it's underutilized and it's going away. So we're trying to preach the gospel of 45L, and hopefully we can help as many building owners, single family or multifamily, utilize this incentive before, if they're not able to. So thank you guys very much for your time.
Thanks, guys.
Thanks, guys.